Hey guys, welcome back to another week where we talk about all things real estate related. The big news in Canadian real estate this week is the rate increase. We just saw it increase again yesterday. So I brought on my favorite mortgage broker, Eric from the Ottawa Mortgage Shop, to explain what's really going on.
How are you?
Good, good. How are you?
Good. So yeah, the Bank of Canada upped their rates by 0.25%, making the prime rate 6.70. Highest we've seen since 2007. But the Bank of Canada did indicate that it's most likely the last hike that we're going to be seeing. We're going to see a nice flat for a little bit, and hopefully the rates going down in the near future, 6 to 12 months. We could see a decrease there. So it's encouraging that we know that it's going to be most likely the last one, and we can start looking towards the future.
All right, so you said that the prime rate is 6.7, but when I'm looking at the news, it's saying that the overnight rate was raised 0.25 to 4.5.
That's right.
So what is the difference between the overnight rate, the prime rate, and like what are we seeing on a typical mortgage right now?
So the Bank of Canada rate, the overnight rate that you're going to see at 4.5%, is the cost that banks, they purchase these bonds at that amount, and the 6.7 is what the bank gives to the consumers. So the Bank of Canada is always going to sell the rates to the banks, and then the banks are going to make profit off of that.
And so are all banks sitting at 6.7 right now, or how does that work and what the banks charge?
Okay, so every bank and lender out there will have the same prime rate of 6.70, except for one, which is TD Bank. TD Bank always has 0.15 more of a prime rate than every other lender. 0.15, so their prime rate is at 6.85. Typically, their discount is a little bit more than the others, which at the end of the day, you end up having the same rate. The reason why they're doing it, profit margins, but yeah, they're the only lender or the only bank that does that.
So are we seeing different banks compete against each other and dropping their rates, or they're all around the same?
So the fixed rate, the variable rate hasn't moved. So if you're an insured mortgage, you can get something at prime minus 1%, 1.1%. Where we've seen more traction is on the 5-year fixed and the 3-year fixed. So the 5-year fixed right now is as low as 4.48. So if we look at the difference between 6 months ago, the insured rate was at 5.24. So we almost see a 1% drop on the 5-year fixed rate. And the very popular one is the 3-year fixed. A lot of people are going on the 3-year fixed for that. Once the rates start going down, they'll be able to benefit from newer rates, and those are around 4.99, 4.89 right now, which is extremely aggressive as well. So we've seen a drop. You're going to see, I think the banks are now knowing that most likely the Bank of Canada will not move anymore. It will create more of a stability in the market. They're going to be able to run their numbers a little better and prepare themselves to be a little bit more aggressive when it comes down to the rates now.
Okay, so you see things that are getting a little bit better?
Well, we'll see. We'll see. The inflation right now is at 6.3, dropped from 6.8, and this is December numbers. The next rate hike is supposed to be March 5th, so we'll see. We'll see what happens for January and February inflation. If it keeps going down, the banks will have to move.
Okay, and so this is all good for people who are looking to get into a mortgage, but what about people who bought last year, the year before, and they're on variable and they're starting to see their payments go to the point where they can't afford it anymore?
Yeah, we see a lot of clients calling, to help increase the cash flow. Some clients out there, their mortgage went up by $1,000 a month. Definitely, you don't budget for $1,000 a month. 100 maybe, but 1,000 is very tough. So we help in those cases to either switch the mortgage into a shorter term, fixed term stability and better payments, or we refinance to sort of help the cash flow, get rid of debt, and put some money aside to help to balance out the difference in payments that they're seeing. this is a 1 to 2 year plan, and then they'll be able to benefit from better rates and better budgets. But there's a lot out there, so my suggestion is it takes a phone call to see if something can be done, and it could save you the headaches and the stress from your mortgage payments or credit card payments, whatever it is. So yeah, give a mortgage person a call, and they'll definitely help you.
All right, thanks for that. I think a lot of people are kind of wondering what it means for both being on the variable rate and what it means for these increases. On my side of things, I know that I'm starting to see optimism come back in the market as things have leveled out. We've been through a lot of uncertain times, a lot of people sitting on the fence of what to do. But I think right now we're starting to see things level off and make a little sense.
100%. I think in February you're seeing a lot more pre-approvals, people getting back into the market. They're seeing that they're able to get the good deals on the houses that are out there right now, and benefit from the lower prices. So we've seen a big increase in pre-approvals.
Yeah, I think that matches with what I'm seeing on the buyer side as well. But yeah, thanks. I actually found that really informative. I
My,
hope everyone else did as well.
it's my pleasure.
All right, and I'll see you next time.
Thanks.